What if I told you that one company has built a digital world so vast you could shop, work, travel, eat, and even see a doctor without ever leaving its ecosystem? That company is Alibaba. Most people think of it as just the Amazon of China, but that is a massive understatement. Today, we are going to do the ultimate deep dive. We are going to break down the entire Alibaba business piece by piece, leaving no stone unturned so that by the end of this video, you will have a complete and total understanding of how this digital empire truly works. In today's deep dive analysis, we are going to unpack everything you need to know about Alibaba Group to give you a complete picture. We have structured this video into 7 key sections. First is its business model. Here, we will break down how Alibaba actually makes its money, from its core commerce platforms to its cloud and logistics arms. Secondly, its growth drivers. We will look at the key catalysts that could propel the company's growth in the coming years. Next, its moat. We will analyze its competitive advantages and what protects it from rivals. Then, we will cover its management. We will examine the leadership team steering the ship, followed by its risks. Here, we will discuss the significant challenges and headwinds facing the company. Next, its financials. We will dive into the numbers, looking at its balance sheet. Finally, its valuation. We will try to put a price on the company and determine if it is trading at a fair value. By the end of this video, you will have a comprehensive framework to understand Alibaba as a business and as a potential investment. Now, before we get started, a very important disclaimer. This video is for educational and entertainment purposes only. It is not financial advice. Investing involves risk, and you should always conduct your own thorough due diligence or consult with a qualified financial advisor before making any investment decisions. All right, with that out of the way, let's jump right into Section 1, Alibaba's business model. Just a heads up, this is a very detailed analysis, so it is a long video. I have included timestamps in the description, so feel free to save this video and watch it at your own pace. This section is designed to give you an idea on how Alibaba businesses operate. To truly understand how this giant operates, we will break its business model down into 7 key components. First, its massive core in China commerce. Second, its global ambition with Alibaba International Digital Commerce. Third, the tech brain, Cloud Intelligence Group. Fourth, the financial backbone Ant Group and Alipay. Fifth, its innovation lab, the all other segment. Sixth, where the profits actually come from and how these different business units contribute to the company's overall financial health. And finally, a big picture overview of its grand strategy for the future. This will be detailed, so grab a drink and let us get started. Let us begin with the foundation of the entire empire, the China commerce. This is the foundation of everything. It is where Alibaba started and where it built its staggering user base of over 1.1 billion people in China, shared between its 2 flagship platforms. Let us look at the first of those platforms, Taobao. Think of it as a sprawling digital bazaar or eBay on steroids. It is a C2C consumer-to-consumer platform where individuals and small businesses can open online shops to sell directly to consumers. The product assortment is truly massive and diverse. But Taobao is more than just a store. It is a community. The platform thrives on social commerce, with sellers using engaging tools like live streaming, short-form video, and interactive forums to connect with shoppers, demonstrate products, and build a following. At Taobao, you can shop with complete peace of mind because it uses an escrow-based payment system powered by Alipay. Your money is held securely and is only released to the seller after you have received your product and confirmed that you are satisfied. This system was the cornerstone for building trust on the platform. For a fun fact, one influencer known as the Lipstick King once sold 14,000 lipsticks in just 1 minute on a live stream. That is more than 230 lipsticks sold every second. Taobao is not just a marketplace. It is also the central traffic funnel for the entire ecosystem. This means that Taobao is the first touchpoint for many users to connect them to Alibaba's other businesses, such as Elmi, Fliggy, Amap, etc. Alibaba has a wide user base. The scale here is hard to wrap your head around. We are talking about 928 million monthly active users as of March 2025. That's nearly the entire adult China population, and to give an idea of its sales, Those users helped Taobao and Tmall process a staggering $1.4 trillion in sales in 2024. So, if Taobao is the sprawling digital bazaar, Tmall is the curated high-end shopping mall right next door. Its foundation is built entirely on trust. Tmall is a B2C, which means business to consumer, platformed exclusively for official brands, and they take that seriously. Every seller must be a licensed business selling 100% authentic products, which gives consumers total peace of mind. This secure environment is exactly why you see global giants like Nike and Apple building their official flagship stores on Tmall. They get to create immersive, fully customized brand experiences, not just simple product pages. And to help them thrive, Tmall provides a powerful marketing arsenal that allows businesses to perform live streaming and execute targeted ads. For example, during the world-famous Global Shopping Festival 11.11, which was also invented by Alibaba. Alibaba uses a powerful tool to cultivate its most valuable customers, the 88 VIP membership program. This exclusive invitation-only membership is not open to the public. It is offered only to Alibaba's most active and high-spending customers. More than just a rewards plan, the 88 VIP program is a strategic way to build customer loyalty and increase stickiness with its apps. This exclusive group, which represents the company's top consumer segment, surpassed 50 million members in the 2025 fiscal year. Its benefits are integrated across the entire Alibaba ecosystem. Next, Taobao Instant Commerce. Now, what if you want something right now? That is where Taobao Instant Commerce comes in. Imagine making an order, and in just 30 to 60 minutes, it is at your doorstep. This express delivery service handles a broad variety of goods, including electronics, clothing, cosmetics, fresh produce, flowers, and even liquor. It has also expanded into niche categories, like on-demand document printing. To win this competitive space, Alibaba has launched subsidy campaigns with coupons and discounts to intensify the battle with rivals like Meituan and JD.com. The strategy focuses on high-frequency purchases of daily necessities to drive more user visits, which then generates more revenue from ads and cross-selling, etc. The investment here is massive. Alibaba has committed 50 billion RMB to grow this business. Since its launch, the growth has been explosive. By August 2025, it was approaching 300 million monthly active consumers, a 200% increase since April of that year, with a peak daily order volume of 120 million. So, who powers these super-fast deliveries? Meet Elmi, which literally means, "Are you hungry?" While its main business is restaurant food delivery, its role is much bigger. Think of it as the logistical backbone for Alibaba's other major services. Its powerful infrastructure is critical for enabling the super-fast deliveries of both Taobao, Instant Commerce, and Tmall Supermarket. Its delivery network is powered by a large fleet of riders and integrates sophisticated AI for route optimization and demand forecasting. Next, Xianyu. But what about second-hand goods? That is where Xianyu or Idlefish comes in. It is China's largest C2C or consumer-to-consumer marketplace for used items. Alibaba dominates the market with an incredible 70% market share. But Xianyu is much more than just a place to buy and sell. It has evolved into a multifaceted social commerce platform, especially popular with China's young, budget-conscious consumers. The platform is designed to foster a sense of community around shared hobbies and interests. Here are also some stats on Xianyu. It boasts a massive user base, with the number of registered users exceeding 600 million. This indicates a deep penetration into the Chinese market, with a significant portion of the population having access to the platform. As of March 2025, Xianyu's monthly active users surpassed 200 million during peak periods like the 2024 Lunar New Year. Xianyu's daily GMV averaged over 1 billion RMB. This highlights the significant volume of transactions occurring on the platform every single day. Lastly, over 40% of the platform's users were born after 1995, making it a key hub for Gen Z to trade goods, discover unique items, and even find side hustles and services. These figures collectively paint a picture of Xianyu as not just a leading second-hand e-commerce platform, but as a vast and dynamic ecosystem that is central to the circular economy and consumer culture in China, particularly among its youth. Finally, we have 1688.com. This is Alibaba's premier business-to-business, B2B wholesale and sourcing marketplace, but with a specific focus. It operates exclusively for China's domestic market. The platform's core function is to connect manufacturers, wholesalers, and factories directly with Chinese businesses looking to source products and materials. By providing this direct link, 1688.com effectively cuts out the middleman and increases connectivity. To get an idea of the size and scale of single quotes, 1688.com, there are over 120 million registered buyers and more than 1 million storefronts. A significant portion of these buyers are business owners who source products for their own retail operations, including many sellers on platforms like Taobao, Tmall, and even internationally on Amazon or local e-commerce sites. These figures confirm that 1688.com is not just a website. It is a massive digital ecosystem that forms the backbone of a significant portion of China's manufacturing and retail supply chain. So that wraps up China commerce, but Alibaba's mission is to make it easy to do business anywhere. This brings us to part 2. Alibaba International Digital Commerce, or AIDC. In today's interconnected world, global trade is more dynamic than ever. And at the forefront of this digital revolution is Alibaba International Digital Commerce. But what exactly is AIDC, and how vast is its reach? Let us break it down. AIDC is not just one website. It is Alibaba Group's dedicated segment for all its international commerce businesses. Think of it as the powerhouse driving global trade, consumer and wholesale, outside of mainland China. Its mission is to build the future infrastructure of commerce, making it easier for anyone, anywhere, to do business globally. One of AIDC's crown jewels is Aliexpress. This platform brings millions of products directly from Chinese manufacturers and sellers to consumers worldwide. It is especially popular in Europe, Brazil, and other emerging markets. To understand its scale, consider this. Aliexpress connects with a massive global consumer base. As of the latest reports, Alibaba International Digital Commerce, which includes Aliexpress, serves over 300 million active consumers globally. That is a staggering number, highlighting its reach into diverse markets. Beyond Aliexpress, AIDC's portfolio is incredibly rich. In Southeast Asia, AIDC operates Lazada, a leading e-commerce platform. Lazada is a powerhouse, serving over 160 million active consumers annually across 6 key markets, including Indonesia, Malaysia, the Philippines, Singapore, Thailand, and Vietnam. It is not just about selling. Lazada is deeply integrated into the local economies, even developing its own logistics network. Then there is Trendyol, a dominant force in Turkey. This platform is more than just e-commerce. It is a super app, offering everything from fashion and groceries to food delivery. Trendyol has an incredible 30 million active buyers and processes over 1 million packages daily, making it one of the largest internet companies in the MENA region. Here, Trendyol commands an estimated market share of around 34% of Turkey's fragmented e-commerce market, making it the market leader. And in South Asia, AIDC leads with Daraz, the region's premier online marketplace. Covering Pakistan, Bangladesh, Sri Lanka, Nepal, and Myanmar, Daraz connects millions of buyers and sellers. Driving digital transformation in these fast-growing economies, it is a truly localized e-commerce experience. In countries like Pakistan, it holds a commanding market share, often estimated to be over 50%. By building out its own logistics and payment infrastructure in these developing digital economies, Daraz established a first-mover advantage and a level of trust that makes it the go-to platform for millions. But AIDC is not just about consumers. It also powers Alibaba.com, the world's leading B2B e-commerce platform. Think of it as the global counterpart to 1688. It is the digital bridge for international wholesale trade, facilitating transactions that often run into the billions of dollars annually, while 1688 is designed specifically for the Chinese wholesale market by posing significant barriers for foreign buyers, such as the use of Chinese language. Alibaba.com offers a smoother, more secure international experience. It supports English and provides international logistics services, making it far more accessible. As of March 31, 2025, Alibaba.com stands as China's largest integrated international online wholesale marketplace by revenue. And here is a fun fact. Many international buyers keen on getting those lower 1688 prices often use sourcing agents to overcome the language barrier and navigate the site. An interesting insight is AIDC's strong emphasis on hyperlocalization and ecosystem building. Unlike some global players who adopt a one-size-fits-all approach, AIDC's platforms like Lazada, Trendyol, and Daraz are deeply tailored to their local markets, from payment methods and logistics to product assortments and marketing. They invest heavily in local talent and infrastructure, making them integral parts of their respective local digital economies. This strategy is critical to their success and incredible growth. In summary, Alibaba International Digital Commerce is a monumental force. With hundreds of millions of active consumers, a diverse regional powerhouses like Aliexpress, Lazada, Trendyol, and Daraz, and the global B2B reach of Alibaba.com, AIDC is not just facilitating global trade, it is redefining it. It is a testament to Alibaba's vision of making it easy to do business anywhere, for everyone. Now for part 3, the Cloud Intelligence Group. In the 21st century, data is the new oil, and cloud computing is the engine that powers our digital world. While many know Alibaba for e-commerce, one of its most powerful and strategic divisions operates behind the scenes, the Alibaba Cloud Intelligence. So, what is it, and just how big is this digital giant? Let us take a look. The Alibaba Cloud Intelligence segment is more than just data storage. It is a comprehensive suite of digital services providing the powerful infrastructure computing, databases, networking, security, and AI that businesses need to operate in the digital age. It is a complete ecosystem designed to drive digital transformation for any organization. For the fiscal year ending in 2025, the Alibaba Cloud Intelligence segment generated an incredible 112 billion RMB in revenue, which is over $15.5 billion. This makes it one of the largest cloud providers on the planet. In terms of market position, Alibaba Cloud is a global force. According to the latest industry reports, it stands as the #1 cloud provider in the Asia-Pacific region and the dominant leader in China with an estimated 36% market share. Globally, it consistently ranks as the #4 largest infrastructure as a service provider, which places it firmly alongside the American tech giants. To support this, it operates a colossal infrastructure of 30 public cloud regions and 89 availability zones worldwide. Alibaba is also investing massively in Ali Cloud. Alibaba plans to invest 380 billion RMB over the next 3 years to grow Ali Cloud. In the June 2025 quarter alone, capital expenditure investment reached 38.6 billion RMB, and cumulatively, over 100 billion RMB has been invested in AI R&D over the past year, and the results, it is working. Revenue growth accelerated to 26% year-over-year in the June 2025 quarter. Most impressively, AI-related product revenue has maintained triple-digit year-over-year growth for 8 consecutive quarters. This impressive growth is reflected in its deep market adoption. In fiscal year 2025, it served approximately 63% of all top-listed companies in China. AI adoption is also rapidly expanding from large enterprises to small and medium-sized businesses across incredibly diverse sectors like internet services, autopilot, livestock farming, and traditional manufacturing. But the numbers only tell part of the story. To truly understand Alibaba Cloud, you need to look at its strategic insights. The first insight is its powerful push into artificial intelligence. The intelligence in its name is key. Alibaba has developed its own powerful generative AI model, Tongji Qianwen, Tony Qianwen, Tony Chenwen. Instead of just selling computing power, Alibaba Cloud is integrating this AI model directly into its services. This is called Model as a Service, MaaS. It allows businesses of all sizes to build their own sophisticated AI applications on top of Alibaba's cutting-edge technology, without needing to develop their own models from scratch. They are also a key cloud provider for most of China's leading generative AI startups. The second insight is that Alibaba Cloud is battle-tested like no other. For over a decade, it has served as the exclusive technology backbone for Alibaba's own ecosystem, including the Singles' Day Global Shopping Festival. This event is the largest of its kind in the world, processing hundreds of billions of dollars in transactions and over 1 million orders per second at its peak. This proves its technology is not just theoretical. It is built to perform flawlessly under the most extreme pressure imaginable, giving its enterprise clients immense confidence. So, Alibaba Cloud Intelligence is far more than just a division of an e-commerce company. It is a dominant force in Asia, a top-tier global player, and a pioneer in integrated AI. With its massive scale, deep intelligence, and battle-hardened infrastructure, it is poised to be a defining force in the future of business and technology. Now for Part 4, the All Others segment. Beyond its core commerce and cloud platforms, how does a giant like Alibaba stay ahead? That brings us to Alibaba's All Others segment. This is a diverse portfolio of businesses focused on innovative initiatives, designed to maintain a competitive edge and drive future growth by investing in strategic opportunities. Think of it not as a random collection, but as Alibaba's incubation ground, the place where it builds and tests the future of commerce. Let us break down its key components and their incredible scale. Let us start with logistics, which is Cainiao. So, what is Cainiao? Launched by Alibaba in 2013, Cainiao operates as a global logistics platform or ecosystem. Instead of trying to own every part of the supply chain, its primary role is to be the technological brain that standardizes, coordinates, and optimizes a massive network of partners, from the largest shipping lines to the local courier next door. Its global reach is immense. Cainiao's network spans over 200 countries and regions. On a daily basis, it processes an average of over 40 million cross-border parcels. A key part of its international strategy is its premium 5-day global delivery service. Through heavy investment in its own infrastructure, including over 300 overseas warehouses and chartered cargo flights, Cainiao can now deliver packages from China to key global markets in just 5 working days, a revolutionary speed for cross-border e-commerce. Domestically, Cainiao is the backbone of China's e-commerce boom. During peak events like the Singles' Day Global Shopping Festival, its network has proven capable of handling well over 1 billion packages in a matter of days. And to solve the crucial last-mile problem, Cainiao has built a network of over 180,000 neighborhood post stations where customers can conveniently pick up and drop off packages. The figures are impressive, but the strategy behind them is what truly sets Cainiao apart. The first insight is its unique platform model. Cainiao is a technology company first, a logistics company second. Its core product is data. By providing a single digital platform for its thousands of partners, it creates a smart logistics network that optimizes everything from choosing the most efficient delivery route to predicting inventory needs for merchants. This reduces costs and improves speed across the entire industry. Secondly, Cainiao's model is evolving. It began as an asset-light company, focusing purely on technology and partnerships. But to guarantee the quality of its premium services, like 5-day global delivery, it has become asset-smart. This means it is now strategically investing in and operating its own critical infrastructure, like major international sorting hubs, warehouses, and cargo planes, while still partnering for the final mile delivery. This hybrid approach gives it both flexibility and control. Finally, Cainiao has transformed from a cost center designed to simply support Alibaba's e-commerce platforms into a powerful, competitive business and profit center. A significant and rapidly growing portion of its revenue now comes from external clients, including other major brands and merchants who are not part of the Alibaba ecosystem. This proves it is a world-class logistics provider competing directly on the global stage. So, Cainiao is not just moving boxes, it is moving data. It is a technology powerhouse, an ecosystem orchestrator, and a formidable global competitor, fundamentally reshaping the future of e-commerce logistics. Next, Fresh Hippo. Let us look at how Alibaba is revolutionizing retail with Fresh Hippo, the crown jewel of its new retail vision. Launched in 2015, Fresh Hippo, also known as Hema, is far more than a supermarket. It is a restaurant, a fulfillment center, and a technology showcase all in one, designed to seamlessly merge online and offline shopping. The core of its model rests on 2 revolutionary features. First, rapid 30-minute delivery for anyone living within a 3-kilometer radius. Second, an obsessive focus on freshness, with high-quality produce and live seafood sourced through Alibaba's global logistics network. You can even pick a lobster and have it cooked for you right in the store. And this model is a proven success. As of 2025, Fresh Hippo operates nearly 380 stores and has achieved sustained profitability, with its total sales value exceeding 75 billion RMB. The most telling statistic, over 60% of those sales come from online orders through its app. So, how does Fresh Hippo make this all possible? The secret is its data-driven approach. This starts with a personalized experience. The Fresh Hippo app learns your shopping habits to tailor recommendations and promotions specifically for you. It even links what you buy in store to your online profile, creating a complete picture of your preferences. Next, data creates smart in-store operations. Fresh Hippo uses electronic shelf labels, allowing prices to change dynamically based on demand or freshness. It also analyzes in-store traffic patterns to optimize the store layout, making your shopping trip faster and more intuitive. Finally, data powers hyper-efficient delivery. This is the magic behind the 30-minute promise. Each store uses local data to predict and stock precisely what its neighborhood needs. This means a store near a university will carry more grab-and-go snacks, while one in a residential area stocks more fresh produce and family-sized items. When you order online, an employee is guided on the most efficient route through the store to pick your items, which are then whisked away on an automated conveyor belt for immediate dispatch. In short, Fresh Hippo is not just guessing what its customers want. It knows. This allows it to eliminate waste, maximize convenience, and deliver a grocery experience truly built for the digital age. Next, Dingtalk. In today's hyper-connected world, how does work actually get done? We juggle messages, video calls, documents, and approvals across a dozen different apps. But what if all of that could happen in one single, integrated platform? In China, and increasingly across Asia, that platform is Dingtalk. Ding ding? And it is far more than just a messaging app. So, what is Dingtalk? Dingtalk is an all-in-one enterprise collaboration platform and a super app for work. An application development into a single, powerful ecosystem designed to manage an entire organization from a smartphone. To say Dingtalk is popular would be an understatement. Its scale is immense. As of 2025, Dingtalk has a massive user base of over 700 million individual users. More importantly, it has been adopted by over 25 million enterprises and organizations, from small startups to multinational corporations and even schools and hospitals. In China's competitive enterprise collaboration market, Dingtalk is the undisputed leader, commanding the largest market share by a significant margin. At its core, Dingtalk streamlines work with a suite of powerful tools. It features unified communications with chat messages that show read-unread status, crystal-clear video conferencing, and integrated email. It features powerful communication tools like the signature Ding message, which can send an SMS or even an automated phone call to guarantee that a sent message is seen by its recipient. This feature is why Dingtalk became so essential for organizations that require immediate action and accountability. As it makes urgent communications nearly impossible to miss, it excels at workflow collaboration. Teams can co-edit documents in real time, manage projects with shared task lists, and, crucially, digitize any business process with its approval workflows from expense claims to leave requests, all handled and tracked within the app. But what makes Dingtalk so dominant? Beyond its features, there are a few key insights into its strategy. First, it is an all-in-one super app. Unlike competitors in the West that often specialize, like Slack for messaging, Zoom for video, and Asana for project management, Dingtalk bundles all these functions and more into one platform. This creates an incredibly sticky ecosystem. Once an organization adopts Dingtalk for its core communication, it is seamless to start using it for attendance, approvals, and customer management, eliminating the need for multiple costly software subscriptions. Second, Dingtalk has evolved into a powerful platform as a service, or PAs. This is its secret weapon. It provides low-code and no-code tools that allow companies, even those without big IT teams, to easily build their own custom applications directly on top of Dingtalk. A retail company can build a custom app for store management. A construction firm can build one for site safety inspections. This transforms Dingtalk from a simple tool into a flexible operating system for any business, deeply integrating it into their core operations and connecting them to the power of Alibaba Cloud. On a side note, Dingtalk level of control comes with controversy and surveillance. Features like read receipts and location tracking have been criticized for creating an always-on culture of overwork. The app's impact is so massive that during the 2020 pandemic, frustrated students review-bombed the app with one-star ratings to protest online schooling. This action prompted the company to release a clever, meme-filled apology video. Today, Dingtalk is a key pillar of the Alibaba empire and is now expanding internationally with a version called Dingtalk Lite. In conclusion, Dingtalk is not just an app, it is a fundamental reinvention of how organizations operate. By combining communication, collaboration, and a powerful application platform, it has become the digital backbone for millions of businesses. It is a clear look into the future of work, a future that is mobile first, all-in-one, and completely integrated. Next, Quark. Quark has evolved into the ultimate digital assistant, and it is Alibaba's key weapon in the race to define the future of consumer AI. The app began in 2016 with a very different mission: to be a minimalist, privacy-focused web browser and cloud storage tool. It was popular but quiet. However, Alibaba had bigger plans. They saw the explosion of AI and completely upgraded Quark, transforming it into their killer app. In the AI race, it is now a leading AI-powered information services platform in China, built directly on their powerful proprietary large language model. Qwen AI. It is your all-in-one smart tool for everything from studying to staying organized. Quark is far more than just a popular app. It is a strategic cornerstone for Alibaba's future. Even before its AI upgrade in March 2025, Quark was already huge. But since the revamp, it has quickly become the most popular AI app in China, successfully beating out major competitors like ByteDance's, Taobao, and DeepSeek. This gives Alibaba a crucial lead in the consumer AI battle. By the end of fiscal year 2025, Quark boasted over 200 million monthly active users, and a significant majority of its users are under the age of 25, making it a gateway to the Gen Z audience. Quark is a massive deal because it is Alibaba's first major consumer-facing app to fully use their own Qwen AI models. It serves as a real-world, user-tested showcase for their multi-billion-dollar investment in AI infrastructure and technology. This is where it gets really exciting. In July 2025, Alibaba revealed plans for Quark AI glasses. These are not just a concept, they will fully integrate with Quark's AI and the rest of the Alibaba ecosystem. Imagine near-eye navigation from AMAP, scanning Taobao products for price comparisons with a single glance, and even making payments with Alipay without pulling out your phone. Ultimately, Alibaba's goal with Quark was to make powerful AI accessible to a huge number of everyday users. Its new, clean, and simple interface makes AI feel easy and not intimidating, which is a major reason for its widespread popularity. Next, Youku. Beyond tools and productivity, Alibaba is also a major player in entertainment, which brings us to Youku. When you think of online video, you probably think of YouTube or Netflix. But what about in China? The landscape is completely different, and one platform stands out as a true entertainment powerhouse. Youku, often described as China's YouTube, that comparison only scratches the surface. Youku is a strategic beast, a massive hub for professionally produced content that is not just about watching videos, but about entirely new forms of digital commerce and entertainment. At its core, Youku is one of the top 3 players in China's major online video platforms. But unlike YouTube's user-generated roots, Youku's primary focus has always been on professionally produced content. Think less of home videos and more of a hybrid powerhouse like Netflix, Hulu, and a traditional TV network all rolled into one app. It is a huge destination for Chinese entertainment, offering a ton of TV shows, blockbuster movies, lively variety shows, and exclusive original content. It is the go-to place for fans, especially for the immensely popular C-dramas, Chinese dramas, and viral video clips. Youku's true power lies in its seamless blend of entertainment and commerce. While watching a show, you can tap on a product on screen and be taken directly to its Tmall or Taobao store page. This creates an incredible synergy by combining your viewing habits with your shopping data, allowing Alibaba to create highly targeted ads. Youku has been operating at a loss for some time and has been losing market share. It once held 60% of the entire market, but has since seen its share decrease due to strong competitors like Tencent Videos and iQIYI. Despite this, Youku remains one of the top 3 players in the industry and acts as a key sales channel, providing essential synergy with Alibaba's other businesses. As of 2025, Youku consistently maintains a massive audience, with its daily active users averaging over 100 million. Its monthly active users often exceed 400 million, placing it firmly in the top tier of China's fiercely competitive video streaming market. Next, Damai. And if Youku is for entertainment at home, what about live events? For that, you go to Damai, which is China's biggest online ticketing platform. Think of Ticketmaster, but fully integrated into the vast Alibaba digital universe. It is the go-to spot for everything from concerts and music festivals to sports games and plays. Damai was acquired by Alibaba in 2017. It is deeply connected to the ecosystem. This means a seamless experience for users, with easy payments through Alipay and connections to the video platform Youku. It has achieved market dominance. It is the exclusive ticketing partner for approximately 90% of all top-tier stadium-level concerts in China and commands an estimated 60 to 70% of the market share for online ticketing of major concerts and live events. It also has over 100 million registered users. So, what makes Damai so strategically important? The first insight is its role as a cultural barometer and a key offline touchpoint for Alibaba. Damai has its finger on the pulse of what is popular in the real world. This data is incredibly valuable, allowing Alibaba to identify trends and create synergies. For example, a successful concert tour ticketed on Damai can lead to related content on Youku or merchandise sales on Taobao. The second insight is its deep integration with event promotion and technology. Damai is not just a seller, it is a partner to promoters. It provides them with data analytics to better understand their audience, marketing support to reach more fans, and cutting-edge on-site technology like paperless entry and facial recognition systems to ensure events run smoothly and securely. Ultimately, Damai is Alibaba's bridge between the digital and physical worlds. It masterfully converts the passion of a live event into a stream of valuable data and new users, creating a perfect loop where real-world excitement drives online engagement. In Alibaba's strategy to be everywhere the consumer is, Damai secures its place at the heart of their most memorable experiences. Next, Alibaba Health. From entertainment, we now turn to one of the most vital sectors, healthcare, and Alibaba's ambitious play, Alibaba Health. The core of this platform is a massive online pharmacy. Through Tmall Pharmacy, millions in China can buy everything from vitamins to prescription medications, conveniently and discreetly. But it is much more than a pharmacy. It is a full-service internet healthcare ecosystem, offering digital doctor consultations that are critical for bridging the healthcare gap between big cities and rural areas. Alibaba Health acts as a digital bridge between China's advanced urban medical centers and its remote communities. It also has a drug traceability platform to fight counterfeit medications. The platform serves over 300 million annual active consumers, making it one of the largest, if not the largest, digital health platforms in the world. Amongst the 3 biggest players in China, with JD Health and Ping, and Good Doctor being the other 2 players, Alibaba Health is by far the largest, with annual active users coming in at 300 million, JD Health having 200 million, and Ping and Good Doctor coming in at 31 million. In conclusion, Alibaba Health's most profound impact today is its ability to erase distance. By bringing top-tier doctors to remote villages via video and delivering essential medicine to the furthest doorsteps, it has transformed healthcare from a privilege of geography into a fundamental right for all. But this is just the beginning. The ultimate vision is a future of truly preventative and personalized healthcare. Imagine a world where your smartwatch detects an early health anomaly. The platform's AI analyzes the data and you are proactively connected with a doctor for a consultation and a prescription arriving at your home before you ever feel seriously ill. This is the future Alibaba Health is building, a seamless, intelligent system that does not just treat sickness, but actively works to keep you healthy, all from the comfort of your living room. Now for Part 5, Ant Group and Alipay. Ant Group and Alipay are the financial backbone of the entire empire. Imagine leaving your house for the day with nothing but your smartphone. You buy your morning coffee, pay for your train ride, order lunch, and even pay your electricity bill, all without ever touching cash or a credit card. For hundreds of millions of people, this is their daily reality, and the engine behind it is one app, Alipay. To understand its power, let us look at its origin story. Alipay started in 2004 to solve the trust problem for Taobao. It acted as an escrow service, holding a buyer's money until they confirmed they received their goods. This single innovation built the trust needed to unlock China's e-commerce revolution. But it was a simple, black and white square that triggered its real revolution. The QR code. While the West focused on credit cards, Alipay blanketed China with QR codes. Everyone from high-end malls to street food vendors could accept digital payments. It completely leapfrogged the credit card era, turning China from a cash society to a near cashless one in just a few years. Replacing cash was just the beginning. The next step was the super app transformation. Alipay used its payment gateway to build an entire digital world. Inside the app, you find a complete financial hub with services like Youbao for investing spare cash and Weibiei and Gibei for virtual credit and small loans. But it goes even further. Through many programs inside Alipay, you can hail a taxi, order food, manage social security, and even access government services. It is your wallet, your bank, and your city hall in a single icon. And now, that influence is spreading globally with Alipay Plus, a global initiative connecting various local e-wallets across Asia. So, when you think of Alipay, think of an entire operating system for daily life. Today, Alipay, operated by Alibaba affiliate Ant Group, boasts over 1.4 billion monthly active users, commands about 54% of China's mobile payment market, and is accepted in over 110 countries. Alibaba itself holds a significant 33% stake in Ant Group. We will now move on to part 6. Where does the money come from? With all of Alibaba's famous ventures, you might be surprised to learn that its profits come almost exclusively from one single source: the China commerce retail segment. This division is so dominant that it accounts for nearly all of the company's operating profit. In stark contrast, most of its other famous ventures like international e-commerce and its logistics arm are currently loss-making. So, how does this one segment generate such massive profits? It boils down to 3 main drivers. First, and by far the largest, is advertising and marketing services. Merchants pay for visibility on Taobao and Tmall. Second are commissions, where sellers on the premium Tmall platform pay a percentage of every sale to Alibaba. And third, membership fees from programs like the 88 VIP Loyalty Club. Essentially, the China commerce segment is the cash cow that funds all of Alibaba's other ambitious ventures. However, there is a crucial shift happening. Losses in the other segments are shrinking, and Alibaba Cloud is starting to show improved profitability. The first sign that one of its big future bets is beginning to pay off. After looking at everything, we arrive at our final section, Part 7, the grand strategy. So, what is the end goal here? The answer is no. It is not just to be the biggest online store or the biggest cloud provider. Alibaba's true ambition is to build the digital infrastructure for the future of commerce and daily life itself. Think of it less as a collection of separate businesses and more as a single, seamless operating system. Let us see how this interconnected ecosystem works in action. They do not just want you to shop on their platform. They want the merchant you buy from to run their business on Dingtalk, to host their website on Alibaba Cloud, and to use Cainiao logistics to ship their goods. They want you to manage your wellness on Ali Health and explore your curiosity with Quark. Each service, each app, is a tile in a much larger mosaic. Their original mission was to make it easy to do business anywhere. Today, that has evolved. The goal is now to provide the essential, interconnected tools for everyone from the smallest seller to the largest enterprise to thrive in a digital-first world. In the end, Alibaba does not just want to be a company you use, it wants to be the ecosystem you live, work, and build your future in. Section 2. Growth Drivers. We have previously dissected Alibaba's complex business model and saw how it became the giant it is today. But now we are looking forward. The question on every investor's and analyst's mind is, where does Alibaba go from here? How can a company this massive continue to find new avenues for explosive growth? The answer is not a single silver bullet, but a comprehensive four-part vision for the future. Let us break it down. First, let us look at the two absolute powerhouses driving Alibaba's future: AliCloud and International Digital Commerce, AIDC. These are not just businesses. They are Alibaba's strategic pivot into new eras of technology and global reach. Let us start with AliCloud, the digital backbone of the entire operation. This marks Alibaba's evolution from a retail giant into a core technology company. Think of it this way. If the e-commerce platforms are the city's storefronts, AliCloud is building the essential infrastructure that powers everything: the power grid, the waterworks, and the highways for the data-driven economy. So, just how big is this opportunity? To understand the scale, we need to look at the total addressable market, or TAM. The cloud computing market in China alone is set to skyrocket. We are looking at an increase from $50.47 billion in 2025 to a staggering $135.84 billion by 2030. That is a compound annual growth rate, CAGR, of 21.90%. What is fueling this fire? A nationwide push for digitalization, the explosive adoption of artificial intelligence, and a massive wave of businesses moving their operations to the cloud. Now, while competition from Huawei and Tencent Cloud is fierce, AliCloud, as an early mover, held a leading 39.4% market share in China as of early 2024. While that share might fragment slightly, it is expected to comfortably retain over 30% in the medium term due to its deep integration with Alibaba's vast ecosystem. But here is the real kicker. AliCloud's AI-related product revenue has maintained triple-digit year-over-year growth for 8 consecutive quarters. That is over 100% growth every quarter for 2 straight years, fueled by surging AI demand. This places Alibaba at the very heart of the AI revolution. Next up is Alibaba International Digital Commerce, AIDC, the global conquest. This is Alibaba's answer to saturation in its domestic market, a massive push into new global territories. The global cross-border e-commerce market is a colossal prize valued at $2.3 trillion in 2024, projected to reach $6.2 trillion by 2030. That is an impressive CAGR of 16.5%. A key battleground for AIDC is Southeast Asia, where the e-commerce GMV is expected to hit $363 billion by 2025, with an 18% CAGR. AIDC has been a standout performer. Its revenue surged from 34 billion RMB in FY 2020 to over 102 billion RMB in FY 2024. This consistent upward trajectory is thanks to strategic investments in platforms like Lazada, Aliexpress, and Trendyol. While Lazada faces stiff competition in Southeast Asia, Aliexpress is a dominant force in cross-border e-commerce across Europe and Latin America. With significant investments in logistics and user experience, AIDC is well-positioned for sustained market share gains in these emerging markets. Now, let us turn our attention back to China for Part 2. Stabilizing giants and hypergrowth niches. While the growth engines push forward, Alibaba also has to manage its massive foundational businesses and capitalize on new, rapid growth opportunities within its home market. We will start with the bedrock, China commerce. Featuring the Taobao and Tmall group, this is Alibaba's historical heart. Taobao and Tmall, they represent the mainstream of online retail in China, catering to planned purchases with traditional next-day or multi-day delivery. The core Chinese e-commerce market is the largest in the world, with a TAM projected at $3.3 trillion in 2025. It is the bedrock of Alibaba's revenue. However, as a mature market, its growth is moderating. With a projected CAGR of about 8.9% from 2025 to 2029, growth here is no longer about exponential user acquisition, but about increasing online penetration in lower-tier cities and boosting average spend per user. Revenue growth for this segment has slowed to low single digits in recent years, reflecting market saturation and intense competition from players like Pinduoduo and Douyin. While their combined market share between Taobao and Tmall, once over 70%, now sits around 45 to 50%. Alibaba's strategy is to defend this share by enhancing user engagement through rich content and offering better value for money. It is about maintaining leadership in a fiercely competitive but still growing market. Now for the hypergrowth niche, China instant commerce, where speed is king. This segment is all about speed and convenience, featuring Almi and Fresh Hippo. Think groceries, pharmaceuticals, and electronics delivered within 30 to 60 minutes from local stores. The TAM for China's instant commerce market is exploding, projected to reach over 4 trillion RMB by 2026. This is fueled by consumer demand for immediate gratification and the digitization of local brick-and-mortar stores. This sector boasts a much higher growth potential than traditional e-commerce, with a projected CAGR of 17% over the next few years. Highlighting its own ambitions, Alibaba has stated a goal of achieving 1 trillion RMB in gross merchandise value from this business within the next 3 years. Revenue from this segment has grown consistently, with non-restaurant deliveries on Almi seeing particularly robust growth, often exceeding 30% year-over-year. While Almi is a challenger in the on-demand delivery market behind Moat, Fresh Hippo is a leader in integrated online to offline supermarkets. Alibaba's success here depends on leveraging its AMAP data, ecosystem stickiness, which includes membership rewards, integrating more local retailers, and intensely competing in this rapidly expanding high-stakes market. Beyond these major segments, Alibaba's vast ecosystem contains several other businesses, each presenting unique, albeit smaller-scale, growth opportunities. Now, Part 3. Emerging Opportunities. The ecosystem's supporting cast. These are critical components that add strength and diversification. First, there is Dingtalk, China's leading enterprise collaboration and software platform, perfectly positioned to capitalize on China's digital transformation and their international expansion. The company's president says he hopes for Dingtalk to grow at 30% CAGR for the next 10 to 20 years. Then we have AMAP, a dominant force in China's mobile mapping and navigation. AMAP's vast user base and data capabilities make it a strategic asset for location-based services and even future autonomous driving. Crucially, AMAP is now deeply integrated with Alibaba's broader AI strategy. Its rich, real-world geospatial data serves as a foundational layer for training and enhancing AI applications across the ecosystem, from the AI-powered search and Quark to the logistics optimization of Cainiao. This AI integration is poised to be a major catalyst for AMA's future growth. It creates a powerful data feedback loop. As users interact with AI-driven services, AMAP's data gets richer, making all connected services smarter and more personalized, which in turn attracts more users. This synergy unlocks new revenue streams beyond traditional navigation, powering next-generation products like the planned Quark AI glasses. It also enables highly sophisticated location-aware services that make the entire Alibaba ecosystem more valuable and harder for users to leave. There is not much data available with regards to AMAP's possible growth. However, taking into account all of its development, I believe we can assign a base case scenario that it can grow at over 12% CAGR next Damai. Damai business has rebounded strongly after pandemic disruptions. In FY 2025, revenue reached about 6.7 billion RMB, up more than 30% year-on-year, while earnings grew even faster thanks to improved margins. This reflects strong demand for live concerts, theater, and intellectual property-driven merchandise. Looking ahead, Damai growth is anchored on 3 key drivers. 1. Live entertainment recovery, strong consumer demand for concerts and offline experiences. 2. Intellectual property and derivatives expansion, higher margin merchandise and licensing businesses. 3. Geographic expansion, tapping into lower-tier Chinese cities and broadening reach. China's live entertainment market is expected to grow at double digits, supported by rising disposable incomes and a shift in consumer spending toward experiences. Damai is well positioned as a market leader to capture this demand. Damai is entering a strong growth cycle, with revenues expected to compound in the teens and earnings likely to grow much faster due to improving margins. If successful in expanding its intellectual property ecosystem, Damai could transform from a ticketing platform into a leading cultural and entertainment powerhouse. With that, we can assign a growth rate of 15% CAGR. Now, let us look at 3 more integral parts of the Alibaba family that are showing incredible potential. Cainiao, smart logistics. Ali Health, and even the challenging but strategic Youku. Let us begin with Cainiao Smart Logistics. The global connector. Cainiao is the logistical backbone of the entire Alibaba ecosystem and a rapidly growing global smart logistics company. It uses an asset-light model, partnering with logistics firms, providing the technology and standards to enhance efficiency for e-commerce and beyond. The market Cainiao operates in is immense. The global logistics market is valued at approximately $12.5 trillion in 2025, and China's smart logistics market alone is projected to exceed $1.1 trillion this year. The global cross-border e-commerce logistics market, a key driver, is expected to grow at a 12.5% CAGR through 2030. Cainiao has shown explosive growth, with revenue surging from roughly $3.1 billion in FY 2022, $12.9 billion in FY 2024. It processes billions of orders annually and is a leader in cross-border logistics for Aliexpress. Its 5-day global delivery is appearing to be doing well, and they are looking to expand to more regions. Its outlook is strong, with a focus on expanding global infrastructure and offering cost-effective, efficient cross-border solutions. Next is Ali Health or Alibaba Health. Digital wellness. Ali Health is Alibaba's flagship in the healthcare sector, operating one of China's largest online pharmacies and providing a range of digital healthcare services like online consultations. The industry is forecasted to grow at a good 17% CAGR over the next 5 years. This is driven by an aging population, rising health consciousness, and supportive government policies. Ali Health has demonstrated phenomenal growth, with revenue growing from around 15.52 billion RMB in FY 2021 to 27.03 billion RMB in FY 2024. It now serves over 300 million annual active consumers and is a market leader in China's online pharmacy space. Its future growth will come from expanding into chronic disease management, integrating with offline services, and leveraging AI for diagnostics. Finally, there is Youku, the content challenge. Youku is one of China's leading long-form video streaming platforms. Operating within Alibaba's digital media and entertainment group, the online video market in China is substantial. Projected at $65.8 billion in 2025, driven by advertising and subscriptions. However, it is a mature market, with a slowing CAGR of 6.7% from 2025 to 2029. Growth here depends on high-quality original content to attract and retain paying subscribers. Youku currently holds around an 18 to 20% market share, trailing Tencent Video and IQIYI, while it faces significant challenges and has historically posted losses. Its strategic importance lies in its role within the broader ecosystem. Their main focus is on improving operational efficiency and reducing losses, leveraging synergies across Alibaba to promote content. And that brings us to our final part, Part 4, Data, Alibaba Ultimate Growth Driver. We have dissected the individual businesses, but to find the true source of future growth, we must look at the one asset that flows between them all, data. The real genius of the Alibaba model is not just the collection of businesses. It is the sophisticated data-driven strategy that turns user activity into new revenue and market expansion. Imagine this: a user on Taobao searches for a new gadget. That single piece of data is instantly leveraged. It helps Alicloud spot consumer trends for its enterprise clients, informs Freshippo's inventory, and even helps Cainiao optimize delivery routes in that user's neighborhood. Every click, purchase, and search across this sprawling empire generates an immense, invaluable pool of data. So how do they actually refine this data into tangible business results? Well, first, it is about driving higher revenue from every single user. For them, personalization is not just for a nice user experience. It is a direct revenue tool. By understanding a user's complete shopping, viewing, and even eating habits, Alibaba's data engine can predict and promote the next logical purchase. This drives powerful cross-selling across their platforms, turning a Taobao shopper into a Youku subscriber, or an Mi regular, which directly increases the lifetime value of every single user. Secondly, they monetize this data through AI services. The ecosystem's data is the ultimate training ground for Alibaba's AI models. This creates a massive competitive advantage for Alicloud, which then packages this intelligence into cutting-edge AI services for its enterprise clients. In essence, Alibaba turns its internal data into a high-margin, external revenue stream, which explains why its AI-related revenue is soaring. Third, they use this data to capture global market share. The real-time data from their commerce platforms, combined with AMAPS mapping technology, makes their logistics arm, Cainiao, incredibly efficient. But this is not just about saving costs. It's a strategic weapon. Faster, cheaper shipping allows platforms like Aliexpress to outcompete rivals in new international markets, using data to directly fuel global expansion and market share acquisition. And finally, they turn these insights into entirely new businesses. Alibaba's data provides an unparalleled real-time view of unmet consumer needs. This acts as an incubator for new ventures. By identifying gaps in the market, Alibaba can launch and scale new services like Alibaba Health or new features within Dingtalk, with a built-in user base and a much lower risk of failure. Today's data is literally used to build the growth engines of tomorrow. Ultimately, this is not just a collection of businesses. It is a data-driven growth flywheel. Data from existing businesses attracts more users and improves services, which in turn generates even more valuable data. This holistic approach, powered by an unparalleled data advantage, is Alibaba's ultimate superpower, ensuring it can systematically create new avenues for growth well into the future. Section 3. Economic Moat. Previously, we have broken down their business model and explored their powerful growth engines. But that brings us to a fundamental question. What protects all of this? What stops a well-funded competitor from simply copying their model and stealing their market share? The answer is a business concept called an economic moat. Think of Alibaba as a massive castle. An economic moat is the set of deep, interconnected defenses, the high walls, the wide ditches, the unbreachable fortress that protects it from invaders. As of September 2025, Alibaba's moat is being tested like never before, but it remains one of the most formidable in the world. It is not just one wall. It is a deeply interwoven system of competitive advantages. Today, we are going to break down the 5 key pillars of this incredible defense. The first and most powerful part of Alibaba's moat is its immense network effect. This is a simple but profound concept. The service gets more valuable as more people use it. First, you have the two-sided commerce network. This is the virtuous cycle at the heart of Taobao and Tmall. Alibaba serves over 1.1 billion active consumers in China. This colossal user base is an irresistible magnet for merchants. More merchants mean more product variety and better prices, which in turn attracts even more consumers. It creates a powerful gravitational pull that is incredibly difficult for any new competitor to disrupt. This network effect extends to logistics with Cainiao. As more logistics partners and merchants join the platform, the entire system gets smarter. With billions of packages flowing through it, Cainiao's data allows for better route optimization, faster delivery, and lower costs for everyone. And of course, there is the payment network with Alipay. With over 1.4 billion monthly active users, its value grows with every person and street vendor that accepts it. It is so ubiquitous in China that it is a foundational utility, locking users into the ecosystem every time they make a payment. The second pillar is Alibaba's unassailable cost advantage, derived from its sheer scale. Simply put, when you are this big, you can do things cheaper than anyone else. Cainiao's logistics scale allows it to negotiate incredibly low rates with shipping partners. By optimizing millions of packages a day, it achieves a cost per package that smaller players can only dream of, giving merchants on its platforms a direct competitive edge. Then, there is Alibaba Cloud. Building a global network of data centers costs billions. Alibaba can spread that massive fixed cost over millions of customers, allowing it to offer powerful computing at a lower marginal cost than its rivals. Finally, think about marketing costs. With a captive audience of over 1 billion consumers, a huge portion of Alibaba's traffic is organic people just going there directly. Competitors have to spend a fortune on ads to attract a fraction of that audience, creating a structural cost disadvantage for them right from the start. The third pillar of the moat is built on powerful assets you cannot see or easily buy, intangible assets. The most important of these is brand equity. In China, the brands Taobao and Tmall are synonymous with online shopping. This deep-seated trust, built over 2 decades, is priceless. It is why the world's biggest brands, from Apple to Nike, set up their official flagship stores on Tmall, reinforcing its reputation for authenticity and directly addressing consumer concerns about counterfeit goods. Our fourth pillar is Alibaba's single greatest superpower, its proprietary data universe. This is not just about having a lot of data. It is about having a complete 360-degree view of the consumer that no competitor can replicate. Think about it. In a single ecosystem, they see what you buy on Taobao and Tmall, how and where you pay for everything with Alipay, where you physically go with Amap, what you watch on Youku, even how your business operates on Dingtalk. This interconnected data stream is the fuel for their entire empire. It powers the hyper-personalized recommendation algorithms that keep you shopping. It drives the super-targeted advertising engine that generates the majority of their profits. And it is the invaluable training ground for their Quen family of AI models, giving them a massive head start in the AI race. This is not data you can buy. It is an asset earned from billions of daily interactions, creating a moat of insight that is virtually unbreachable. Finally, the fifth pillar is high switching costs. Alibaba has masterfully created a walled garden where leaving the ecosystem is a huge pain for everyone. For merchants, it is a nightmare. A Tmall store builds up years of sales history, customer reviews, and a store rating. This reputation is a critical, non-transferable asset. Moving to a competitor means starting from zero. Plus, their operations are often deeply integrated with Alibaba's tools for advertising, logistics, and communication. For cloud customers, the costs are immense. Migrating your company's entire digital infrastructure from Alibaba Cloud is a complex, expensive, and operationally risky nightmare. And for consumers, it is a soft lock-in. Your single login connects your shopping history, payment info, and shipping details across dozens of services. The seamless convenience of ordering food on Elmi, buying a movie ticket on Damai, or shopping for clothes on Taobao, all in one place, makes the idea of using a patchwork of competing apps a high-friction, inconvenient alternative. So, when you look at Alibaba's economic moat, you see it as not just one thing. It is the self-reinforcing network effects, the massive cost advantages from scale, the invaluable, intangible asset of its brand, the unparalleled insights from its data universe, and the sticky switching costs of its ecosystem, all working together. While this fortress is facing its biggest challenges yet, its deep and multifaceted nature makes it incredibly resilient. This is what has protected Alibaba's dominance for so long, and what will be critical to its success in the years to come. Section 4. The Management. So, we have covered Alibaba's business model and its future growth engines. But a company, no matter how great its business is only as good as its leadership. That brings us to a critical question. Who is steering the ship at Alibaba today? And more importantly, are they steering it in the right direction for shareholders? To understand where Alibaba is going, we first need to look at who's now in charge. In late 2023, the company saw a major leadership shakeup, bringing 2 of its original co-founders back to the forefront. CEO Eddie Wu and Chairman Joseph Tsai, this new leadership represents a significant shift, signaling a return to the company's foundational principles of technology and disciplined growth. And to truly grasp the mindset of this new leadership, you have to know the incredible stories of both these men. Let us talk about the architects behind this shift. Joe Tsai and Eddie Wu, representing a return to the company's roots. When you think of Alibaba, you probably think of Jack Ma. But the company would not be what it is today without the quiet strength and strategic brilliance of Joe Tsai and the deep technical prowess of Eddie Wu. These were not just early employees, they were integral co-founders from day one. First, let us start with Joe Tsai, Alibaba's current chairman. His story is legendary. Back in 1999, Tsai was not a struggling entrepreneur. He was a highly successful private equity executive, earning about $700,000 a year at a prestigious firm. He had a Yale law degree and a clear path to immense wealth. Then he met Jack Ma in a small, messy apartment in Hangzhou. Ma had a powerful, almost crazy vision for the internet in China, but little in the way of a business plan. Captivated, Tsai made a decision that many thought was insane. He quit his high-paying job, moved his then-pregnant wife, and joined this fledgling startup for a salary of just $600 a year. This incredible leap of faith showcases his extraordinary foresight and conviction. While Ma was the charismatic visionary, Tsai was the architect. He single-handedly built Alibaba's entire corporate and financial structure, making it understandable and credible to Western investors. He was instrumental in securing crucial early funding rounds, including a pivotal $20 million from SoftBank that kept the company alive. Without Joe Tsai, the financial and legal backbone, Alibaba might never have scaled. Joe Tsai owns about 1.4% of Alibaba, which is a very significant amount considering how large Alibaba is as a whole. Hence, his actions would be aligned with shareholders' interest. Now, let us look at Eddie Wu, Alibaba's new CEO. Eddie is another co-founder and one of the original 18 people who started Alibaba with Jack Ma. But his strength lies in a different, equally critical area: technology. Eddie Wu is a core technology leader. He was Alibaba's first CTO, helping to build the foundational architecture of Taobao and Alipay. He has deep, intimate knowledge of the company's technological DNA and its massive operational systems. Before becoming CEO of Alibaba Group, he was also the CEO of the crucial Cloud Intelligence Group, showing his direct leadership in one of Alibaba's most important future growth areas. His appointment as CEO signals a clear strategic pivot. Alibaba is going back to its roots in technology and e-commerce, with a stated focus on being user-first and AI-driven. This is Eddie Wu's domain. So, you have Joe Tsai, the master strategist and financial guru, paired with Eddie Wu, the deep technology expert. This combination brings back a powerful blend of experience, vision, and execution from Alibaba's earliest, most successful days. Which brings us to the most important question: are they aligned with shareholders? Okay, so these are incredibly qualified individuals with deep ties to Alibaba's success. But what does their return mean for investors today? Are they truly aligned with shareholder interests? The evidence strongly suggests a resounding yes. Since taking the helm, this new management team has made several decisive shareholder-friendly moves. First, massive share buybacks. This is the most direct way to signal confidence and return value. In the last fiscal year alone, Alibaba repurchased a staggering $12.5 billion USD of its own stock. This reduces the number of outstanding shares, boosting earnings per share, and clearly signals management's belief that their stock is undervalued. Second, the initiation of a dividend. For the first time in its history, Alibaba declared a dividend in 2023. This is a significant move for a growth-focused tech company, demonstrating a commitment to directly returning cash to investors, not just reinvesting it. And third, strategic restructuring and focus. The company's efforts to streamline its operations, divest non-core assets, and focus on the profitability of its core e-commerce and cloud businesses are all designed to unlock value and improve capital returns for shareholders. The stated focus on being user-first and AI-driven under Eddie was leadership is about enhancing the core business through technological superiority, which ultimately benefits the bottom line. While challenges remain like the complex Chinese regulatory environment and global market uncertainties, the actions of this new leadership team, under Joe Tsai and Eddie Wu, point to a strong and deliberate alignment with shareholder interests. They are leveraging their unique expertise and deep understanding of Alibaba to maximize value, return capital, and steer the company back to its growth roots, all while navigating a complex global landscape. It is a powerful return to the company's foundational talent, and it is looking very promising for those holding Alibaba shares. On a side note, Jack Ma had stepped down in the late 2020s, however. Recently, he has been seen getting involved back with the company's direction. It was heard that he even made 3 communications with the senior management, asking for updates within the same day. This clearly shows that he is very much involved with Alibaba's strategic directions. His re-engagement could re-inject what we might call the Jack Ma premium. This premium is not just about sentiment, it signals a potential return to bold, visionary leadership. Ma is known for his long-term strategic thinking and his ability to inspire. His presence could reassure both domestic and international investors that Alibaba has strong founder-led guidance during a critical period of transformation. Jack Ma owns about 4.5% of Alibaba, which is a very large amount considering how large Alibaba is as a company. Hence, his actions should be aligned with investors. Section 5. Risks. We have explored its business model, its powerful growth engines, and the formidable economic moat that protects it. But no analysis is complete without a hard look at the risks. Investing is about weighing the potential rewards against the potential dangers. With Alibaba, the risks are significant, and they are the primary reason the stock trades at such a low valuation compared to its peers. So, what are these risks? Let us break them down. Let us begin with our first topic: intense domestic competition. The most immediate threat is the brutal competition in its home market. The era of Alibaba's uncontested dominance is over. Today, it is fighting a multi-front war. In e-commerce, Pinduoduo has captured the value-conscious consumer and is now moving upmarket. Meanwhile, Douyin, the Chinese version of TikTok, has become a powerhouse in live streaming commerce, stealing user attention and screen time from Taobao. In local services, Alibaba's Elmi is locked in a fierce and expensive battle for market share against the dominant leader, Meituan. And in cloud computing, while AliCloud is the market leader, it is facing a brutal price war from state-backed clouds and rivals like Huawei Cloud and Tencent Cloud, which is squeezing its profit margins. This relentless competition forces Alibaba to spend heavily on subsidies and marketing just to defend its turf, directly impacting its bottom line. This leaves a razor-thin margin for error. Any strategic misstep, whether in pricing or innovation, would not just be a minor setback. It is an opening that rivals are perfectly positioned to exploit, leading to huge financial losses and a potential long-term erosion of their customer base. Now for the second risk, which is regulatory and geopolitical uncertainty. Next, we have the great uncertainty: politics and regulation. For years, this has been the biggest cloud hanging over Alibaba. Now let us be clear about the history. The Chinese government's tech crackdown that began in late 2020 was severe. Alibaba faced a record $18.2 billion RMB fine, and Ant Group's massive IPO was cancelled at the last minute. However, the regulatory pendulum appears to be swinging back. In August 2024, China's market regulator officially declared Alibaba's 3-year antitrust rectification complete and even praised its reforms. This, combined with recent high-profile appearances by Jack Ma, who was even seen shaking hands with Xi Jinping, suggests the period of intense punishment is over. To me, it seems clear the goal was never to kill off China's golden goose, but simply to bring it back in line with national priorities. But the geopolitical risks remain. U.S.-China tensions are a major factor. The most direct impact was the U.S. chip export controls. The restrictions on advanced semiconductor technology have significantly impacted Alibaba Cloud and disrupted the company's access to high-performance chips, crucial for the advancement of its artificial intelligence and cloud computing services. However, China has made great efforts to be self-reliant and have made great improvements. Tencent has recently announced that it has fully adapted infrastructure to support homegrown chips, which shows the progress that China has made on this aspect. The long-term, though currently diminished, risk of delisting from U.S. exchanges also lingers. However, U.S. shares can always be converted to Hong Kong shares if needed. The third risk is tied to the broader economy: macroeconomic headwinds. Alibaba's success is directly tied to the health of the Chinese economy. When the economy struggles, Alibaba feels it. A slowdown in China's GDP growth, challenges in the property market, and high youth unemployment have all weakened consumer confidence. When people are worried about their jobs and the value of their homes, they cut back on discretionary spending, and that is the lifeblood of Taobao and Tmall. A weaker global economy could also slow down the growth of its international commerce arm, which is a key part of its future strategy. And finally, let us look at the fourth risk: internal and structural challenges. We have internal and structural risks. As a massive conglomerate, Alibaba faces big company disease, which is the risk of slowing down and losing agility. While its major restructuring is a bold move to combat this, it is a complex reorganization with significant execution risk. So far, the early performance has been promising. Structurally, there is the VI structure. If you buy Alibaba shares in the US, you do not directly own the Chinese company. You own a stake in a Cayman Islands shell company with contractual rights to the profits. While it is a standard practice, it carries a low probability but high impact risk. Again, it is worth noting, however, that you can convert your US shares to Hong Kong listed shares if needed. All these factors contribute to volatile investor sentiment. The stock can swing dramatically on regulatory news or geopolitical rumors, making it a turbulent ride. So, what does this all mean for an investor? Let us get to the takeaway. Investing in Alibaba means accepting these significant risks. The current low valuation is a direct reflection of the market's pessimism. A potential investment in Alibaba today is a bet that these risks, especially the regulatory and competitive ones, are now either resolved or overstated, and that its powerful ecosystem and new management team can successfully execute a turnaround. It is a complex picture, but understanding these risks is the first step to making an informed investment decision. All right, we have talked about various aspects of Alibaba's business. But now, let us get to the question every single investor asks. How strong are the financials? Is this company built on a solid foundation, or is it on shaky ground? Let us dive into the numbers and see what they tell us. First, let us talk about debt. Alibaba has a total debt of about 232 billion RMB. Now, that sounds like a massive number, but a number that big is meaningless without context. The real question is, how does that debt compare to the company's own capital? That is where we look at the debt-to-equity ratio, which for Alibaba is just 23.17%. So, what does that actually mean? It means for every dollar of its own money, Alibaba only owes about 23 cents. That is an incredibly healthy and low-risk ratio. It tells us that the company is not over-leveraged and funds its operations primarily from its own strength, not by borrowing heavily. Now, let us move on to the balance sheet. Here is where the story gets really impressive. It is not just that Alibaba has low debt, it is that it is drowning in cash. Alibaba is in a massive net cash position. They have so much cash on hand that they could pay off every single yuan of that 232 billion in debt tomorrow and still have over 353 billion RMB in cash left over. This is what we call a fortress balance sheet. It gives them incredible financial flexibility to invest, innovate, and weather any economic storm without breaking a sweat. So if they have so much cash, what about their cash flow? This is a crucial point. Right now, Alibaba's free cash flow is negative, but it is crucial to understand why. It is not because the business is failing. It is because the company has recently made a lot of strategic investments to fuel future growth. And we know the underlying business is incredibly powerful because, in the past, this company was capable of generating over 156 billion RMB in free cash flow in a single year. So, what is the final verdict on Alibaba's financial health? When you put it all together, the picture is crystal clear. Despite the recent investments temporarily affecting its cash flow, Alibaba is a cash cow machine. With its low debt, its massive net cash position, and its historically powerful cash-generating ability, the company is in an exceptionally strong financial position. Section 7. Valuation. All right, we have journeyed through every aspect of Alibaba's business. Its intricate models, powerful growth engines, formidable economic moat, the significant risks it faces, and its rock-solid financials. Now, it is time for the ultimate question. What is Alibaba worth? This is where all our analysis culminates. When we look at Alibaba's current valuation, it tells a fascinating story. First, let us look at the market cap, which shows the current reality. As of our analysis, Alibaba's market capitalization stands roughly between $330 to $350 billion. This figure, while massive, is considerably lower than its peak and reflects the deep pessimism we discussed earlier when talking about the risks. Now, let us look at its intrinsic value to see what the numbers say. What does our fundamental analysis, specifically a discounted cash flow DCF model, tell us about what the company should actually be worth? Our DCF analysis, which projects Alibaba's future cash flows and discounts them back to today, suggests an intrinsic value per share in the range of $153 to $182 when you compare that to its current trading price. This suggests there is a moderate upside potential. If the company can simply execute its strategy and reduce some of that market uncertainty. Next, let us cover its relative valuation by making a peer comparison. Let us put Alibaba into context by comparing it to its peers. One key metric we look at is the price to free cash flow to equity, PFCFE ratio. This tells us how much investors are paying for each dollar of cash flow available to equity holders. Alibaba currently trades at approximately 33 times its FCFE. For a company of Alibaba's size, profitability, and market position, 33x FCFE is significantly lower than a direct comparison like Amazon, which often trades at much higher multiples, and even lower than many other global tech giants. This multiple suggests the market is applying a substantial discount to Alibaba. So, what does this all mean for you, the investor? This brings us to the investor's conundrum. Alibaba's valuation reflects a large, stabilized tech and e-commerce company that, on paper, appears fundamentally undervalued. The numbers suggest that if the company can continue to execute its strategic pivot, defend its market share in core areas, grow its international and cloud businesses, and, crucially, if the geopolitical and regulatory environment remains stable or even improves, there is a clear path for its stock price to move closer to its intrinsic value. The decision to invest in Alibaba then boils down to your personal assessment of risk versus reward. Do you believe the current discount adequately compensates you for the risks we have discussed? Or do you see a resilient giant poised to deliver significant returns once these headwinds subside? It is a complex and fascinating story, and the valuation certainly flags it as a company worth keeping a very close eye on. What do you think? Is Alibaba an opportunity you would seize, or a risk you would avoid? Let me know in the comments below. Putting this deep dive together was a huge effort, taking us many weeks of research to bring it all to you. I hope you got a ton of value from that breakdown. If you did, hitting the like and subscribe buttons really helps me know you enjoyed it, and will encourage me to create another deep dive for you. Do you have another company you want to see analyzed? Drop it in the comments below. Thanks so much for watching.